This is a story of around 50 BCE. Julius Caesar crossed the river Rubicon and gave a war cry to his soldiers, Alia Jecta Est, which actually means the die has been cast. There was no returning back. As India unlocks herself between the fight of livelihood and lives, the die has been cast in favor of livelihood. And that, as we live on, we fight the pandemic. Hi, my name is Rahul Pal and I head the fixed income at Mahindra Manulife Mutual Fund. We are referring earlier to India unlocking herself, and there have been some very good signals in terms of the economic indicators which show a gradual uptick. Electricity production, vehicle registration, we have some of the e-way bills and some payment settlement indicators which show an uptick which is happening gradually. So this was the good news for the Indian economic indicators insofar as the unlocking of the nation goes. The not so comfortable news was rating downgrades by Moody's to BBB minus and Fitch giving a sovereign rating with a negative outlook on India, predominantly because of the increased government debt as a percentage of GDP, and that would remain a concern as we go ahead. For the events that happened besides the rating downgrades, we also saw a second round of Operation Twist being announced by the Reserve Bank of India towards the latter half of the month, in fact towards the end of the month. That's one thing that the Reserve Bank of India is trying now to tackle the steepness of the yield curve. With the 1-year rate and the 5-year rate witnessing an acute steepness, RBI attempts to correct that through the Operation Twist. Insofar as the market dynamics go, the short-term rates remain quite comfortable. We had the liquidity which continued to remain surplus. The 3-month, 6 months and the 1-year rate remained quite steady with a benign bias, moved down by close to 10 to 15 basis points. The longer end of the curve, the corporate bond, rallied by close to 20 basis points for the 5-year and the 2-year also. Overall, despite the negative ratings or a negative outlook by the rating agencies on the sovereign credit, it didn't impact much the domestic currency or the domestic rates. In terms of our outlook, this is what we follow. There's a saying that we should be prepared and not predict. So what we think is we're prepared for a gradual uptick of rates, and that's where the portfolio has been positioned. We think the fact that the GSEC is broadly a hope trade which solely rests on the Reserve Bank of India buying sovereign bonds on its balance sheet. And as we move forward, the government borrowing will start impacting the yields. That's what our belief is. Insofar as our scheme strategies, they are broadly aligned to what our opinion is. For a Mahindra Manulife low duration fund, we are running an average maturity of close to 340 days, not much changed from what we had witnessed last month. And the portfolio YTM is at close to 5.25. For Mahindra Ultra Short Term Yojana, we have an average maturity of close to 220 days, an uptick from what happened in the last month. And the portfolio YTM is close to 4.70. Mahindra Credit Risk Yojana, we had actually a drop in the YTM as we sold a part of the illiquid portfolios, and the portfolio YTM is close to 7.50. the drop in YTM was predominantly as we created sufficient liquidity in our funds, and we intend to deploy the funds as we go ahead and the uncertainty around the credits clear up. For Mahindra Dhan Sanchay Yojana and the other hybrid scheme, Mahindra Manulife Equity Nivesh Yojana, we have a broadly unchanged portfolio and an unchanged duration.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.